This is Justin Pulitzer. This is my weekend review video for January 24th, 2016. A good amount to talk about, but I want to start off with really what's causing this. And many of you know, I'm sure it's been all over the news. I've actually been hearing a lot of people talking about this, that this is basically the worst start to a new year ever in the markets. And this really all began when we moved from the Fed being accommodative to tightening, and really we're on the other side of a policy era. And that's why I have this picture of Janet Yellen up with talk to the hand. You know, the Fed had said that they were going to be data dependent, and they've led the market to believe that they are omnipotent, and they have been pretty correct up until now. The Fed has basically said that they were going to be patient and that they were, they've kind of signaled that they're aware of the problems in the economy, but they really chose to ignore them, and they only seem to key off of one number, and that was the jobs number. The problem with that, though, is that the jobs are not very good. They are very low quality. There's a lot of part-time work. These are bartenders, waiters, waitresses. Over the summer, I believe it was carnival ride operators. And we all know from Schlumberger and from BP and from various other companies that they are going to start rounds of layoffs, and they are going to do what companies always do, reward their shareholders with buybacks and increased dividends. And these are the more high-quality jobs, and they are going to be coming off in the tens of thousands. So the jobs number is not good. GDP, we know that the Atlanta Fed has been cutting their estimates. They are basically almost near zero. I believe the last read I saw was their estimate was 0.7. And, if we get back-to-back negative quarters, we are technically in recession. ISM numbers aren't good. They're below 50. There was a lot of tough talk that, no big deal, the manufacturing number wasn't good, but then the service one wasn't good either. Same goes for PMI, also below 50, and what the president and the Fed have been hanging their hat on has been durable goods orders, and we know that those are starting to crack now too. Boeing has decided to basically cut in more than half their production of 747s, and we all know that autos are dangerously close to peaking. You see all these great auto numbers come up, and the stocks just don't care, as well as problems in the dollar. And I'm going to go through that. But the theme for this is basically the market is very afraid that we are dealing with this Janet Yellen with the talk to the hand, and that they are going to continue to raise interest rates in the face of a slowing global economy as well as domestic economy. So now that we got through what the Fed looks at, let's get into the markets. So here we go. We're into the VIX. So I always talk about 6 market keys being important, that being the VIX, the dollar, the bonds, the oil, the China, and of course the biotechs, which are currently used as also a proxy for risk on and risk off. But let's start off in the VIX. You can see we are now making a series of higher lows and higher highs. That is a very big problem for the market. That signals a shift out of, complacency into more of a fear type of a market. I guess that's what happens when markets kind of change trend and volatility changes trend. However, it has been very orderly. You can see that the first attempt up, we failed at basically the 25s. We came back down, I think quite low actually, then rallied up again. We got to our next point, and now coming back down again. I will say this, I've created I should have probably published this. I'll do a graphic maybe this week, but if you want to just take some notes. So 0 to 15 with regard to the VIX is low volatility. 15 to 17, I believe, is sort of fair. 16 to 19 is medium. 20 to 22 is elevated. 23 to 25 is caution. 25 to 31 is crash risk. And then once you get above 31, I believe you're pretty much in a crash. So those are the ranges that I'm going to currently use. There may be some adjusting that goes on to it, but that's sort of my quite literally back of the envelope calculation. And if you take a look where we are still in elevated volatility. That 20 to 22 area is considered elevated, But we basically don't have crash risk on the table here. It had gotten up there. It was staying a little bit stubbornly high. And we are now back into some support area. 22 and then 20 is the sort of the next ring. And there's some moving averages down here that could may support. So while the fever of crash fear may have broken, we are still in, I would still say a more elevated area of volatility. And I will be comfortable saying that we won't kind of have, there will be no sleep till Brooklyn, so to speak, until the VIX can really crack 20 and stay below 20. If we start getting back above 25, you have to start getting more nervous. So that's the VIX. This is sort of the big problem I see for earnings here. Now, we are a increasingly global society where companies do business overseas. You name it, Apple, Facebook, all of these companies have cited Forex currency as a problem. And we are above, this is sort of the middle band. Anything below here is bearish for the dollar. Anything above it is bullish for the dollar. And we're sort of flagging out here. It's a bit of a rising wedge pattern. Not always the most healthy. Those can usually sometimes lead to breakdowns, but they can also lead to blow-off type of moves. And let's just assume that this is basically 100 on the... let me just take a look here. The DX. Yeah. You could assume basically up here is this is 100, and I don't want to go into the chart too much, but if we do break through 100, it's going to be very easy to get to 105 and 106, and that will not go over well with Mr. Market. So until the fever kind of in the dollar breaks, I am majorly cautious about corporate earnings. This doesn't even need to completely break out. It just needs to stay stubbornly lodged high to wreak havoc on corporate earnings, and we are coming into earnings season here, as we know. The Fed has been mindful of this, but I think they need to get a little bit more diligent. So the Fed, as we know, raised interest rates, and interest rates didn't collapse, meaning bond prices didn't collapse, but interest rates actually, or bonds really rallied and rates declined. That to me says that the market isn't so much worried about the rate hikes as it is about a potential for recession. I've posed in previous videos, and I will reiterate now, that many countries don't have what is very commonplace here is FDIC insurance, and there isn't really a liquid market for very wealthy people overseas to put their money in domestically. So what do? They throw it into United States treasuries. So as you can see, when the fear trade comes on, when people get nervous, they put their money in bonds. Now, the good news, this is sort of a double-edged sword. The lower interest rates are, meaning the higher bonds go, the higher the PE multiple should be for the S&P 500. I've gone into this. When you lower your denominator, your end product is higher, and the risk-free rate is part of that. I know the media and people don't really seem to understand that there is an inverse relationship between prices and yield, but I assure you, I went to one of the finest business schools in all of the land, and when there are lower interest rates, that is very good for stock prices and PE multiples. And when you have bonds come down and their yields go up, their risk equivalent yields becomes more, I guess this becomes more attractive, and people sell stocks and then they put their money into bonds. So it's also, I don't really want to get too into this though, but basically when you're valuing companies, they're valued on a discounted cash flow basis. Also, projects, when corporations take on projects, their hurdle rate goes up. If you want to do a little Googling on this, you can take a look. And that just means more projects are done versus less projects are done. If you had to borrow money at an interest rate that was lower, you'd be able to fund different types of projects. And if you had to borrow at a higher rate, you wouldn't be able to do some. So just keep that in mind. Low interest rates are very good for stocks and good for corporate earnings. Higher ones, not so much. But this does tell me that the market is worried about recession. Why would they be worried about recession? probably because high yield, this is what always happens in every bull market, particularly we've had rates low for so long, it has encouraged some very reckless behavior, meaning people have reached for yield, meaning that they weren't happy with getting nothing in their bank accounts and very little in treasuries, so they put their money into high yield, and that trade has collapsed. The good news is we have some excess on the lows here, and we've gotten quite extended from the 50-day, the 100, even the 20 is first coming up. You can see the 20 has been some resistance here in the past, and along with the 50s, so there is some more room up for continued bounce to the back side of the channel and maybe the 50-day, which is where there was some past resistance. But this pattern here, lower highs and lower lows, is not a good one. That's not what you want to see. So before I would really get comfy in any of these, I would want to see a higher low and then higher highs. So that will remain on watch. The weaker this gets, the more concerning it gets. I will forego showing the JNK because it is very much the same. The oil. Help if I would delete this first, but let's do it. You can see USO has gotten well into the single digits, quite low, and is trying to bounce here. I'm going to show you the CL because just the way the USO is made up with contracts rolling, it's not as pure. I like more purity here, so let's get into the discussion here of CL. So you can see lower lows, lower highs. We are in a bit of a bounce phase here. There are some important reference lows here that back to the 2009 reference low. Let's go 10 years. Let's just do weekly. It's cleaner. You can see we are below the crash lows, so that isn't very bullish. There are some prior reference points here of 33.20 and 37. I think it's possible we could rally up to there. I don't necessarily know that we will, but I do believe that there is some more room to rally. You can see the 20 has been some resistance before. We have a little bit more room until the 20, and it coincides well with 33.20. So we are really on day 2 of an oil rally. So yeah, there you can see there was at least 3 here. So I think that we could see potentially a little bit more. The big problem for oil, we know, is the fundamentals of oil, that companies have levered their balance sheets, and they, no matter what oil does, need to keep pumping and selling to basically meet their debt obligations. I, on my Periscope this week, used the analogy of the mouse and the bell experiment, and I'll go into that briefly. If you want to Google it, you're welcome to. Basically, it's when you take a mouse, put it into a sealed environment under a glass or a bell or what have you, and you leave it, and eventually the oxygen depletes and the mouse suffocates. But in order to suffocate, he starts breathing faster and faster, and with every breath depletes his oxygen further and further, and that is basically the analogy of the oil. They pump more and more, even though the price is going lower and lower, because they need to make basically the same dollars. And as their asset goes lower, they need to pump increasingly more amount of oil to get basically the same dollar amount. Very vicious circle we're in. This is being caused largely because of the amazing advances we have in technology, the horizontal drilling, hydraulic fracturing, as well as the Saudis looking to take market share, hurt our companies, as well as the Iranians, who now have oil coming on, which is still more supply. I have posed in the past that this is a mixed picture. Longer term, bigger picture, this is fantastic for Europe and Asia. They are countries that do not have natural resources, and that has been hindering their recovery quite a bit. In the short term, this doesn't help the 15 to 17% of the S&P 500 that requires their profits come from oil. The immediate lowering of the price of oil is an immediate impact hurting GDP, which will suppress earnings and growth still further. So longer term, this is fantastic news. In the short term, it is very bearish news. And I have said this before, and this is before it became common knowledge, that oil is being used as a global growth proxy. So as long as you see lower lows and lower highs, the markets are not going to find a secure bottom. If oil can bottom and can rally and start putting in higher lows and higher highs, then we will probably see quite a large rally in the stock market. Till then, we remain under caution. The only ways that I feel comfortable playing, if you are so inclined, are with the big integrateds, meaning Exxon and Chevron, because they have impenetrable balance sheets. They are highly unlikely to cut their dividends, at least if oil can kind of find some semblance and some balance soon. If this persists for another year or so, I would have to revisit that thesis. But they have huge balance sheets, and they will be able to pick among the rubble when companies are forced to either go out of business or go into liquidation mode to meet debt obligations, meaning selling assets probably at fire sale prices, and these guys can scoop in and buy them. Exxon, I will caution this, is making lower highs and some slightly lower lows. However, the yield support is kicking in into these reference areas. If you are looking to kind of play the range in Exxon, you want to start selling when it gets close to 80 and start buying when it gets close to the lower 70s, the 72s. As long as you're above 75.98, let's just say 76, I would say that the downside is sort of arrested. Below there, to me, gets a little iffy. I'm willing to give, these areas, this sort of a little bit of room, but you should be a little bit cautious if you start getting below 76. If you're above there, it's a little bit more, I guess, terra firma. They do have some earnings coming up. We'll have to see how this responds to that. I'd like to also hear what they have to say about their view on oil and what they're, if they're going to talk up their dividend. Chevron has already come out and said that they won't be cutting. I would assume Exxon is going to be the same, although I would like to hear it. 50-day here has been a little bit of resistance, so I will say this. If you are a Exxon bull, you should be cautious below the 50. If you are an Exxon bear, you want to start trying right or right out shorts against the 50 and against this regression line. If you're above the regression line, it hasn't been sustainable. If you're below there, that also hasn't been as sustainable. There seems to be checkbacks to the regression line. I'm going to do a little bit more work on that, meaning the dollar value, that when you start getting to certain dollar values passed on the upside and the downside, that could also be part of a mathematical trigger. Like if you get X amount of dollars away, it's a buy, and if you get X amount of dollars away on the upside, it's a sell. Chevron, very similar picture. This one did retrace still a little bit more. We are below a longer-term trend, although just barely. We've been kind of checking back to it. This does look a little bit excessy into some reference levels. So I'm going to say that Chevron, for now, is sort of a lateral range type of a play. When you get to the lower end, it's good for a right or right out play, and when you get to the top, you kind of want to get out. China. Gotta have your China. So we are into close to a reference low here. Let me back up on China for a bit. Let's see, 5-year weekly, will that do it? Yeah. Let me go a little further, even still further. Let's do 15 years just so I don't have to redo it again. All right, so with regard to China, this was the big run-up pre-crash. This was the crash. This has been ever since. And the last year or two, we did have a decent run-up into some kind of reference areas. And unfortunately, it is now falling apart. Leg 1, leg 2, and we are potentially in leg 3 of a 3 to 5 wave move. The good news is we've filled up this triangle down to the 2861. We bounced a little bit ahead of time. So the decline in China could be coming to a bit of a halt for the time being. We'll have to see how this plays out. If you start losing 28.61, there is some room quite lower into the lower 20s, so I would be cautious. What seems to happen is you have the breakdown, the check back, the breakdown, and right now we are still in the move of a check back, so there could potentially be a little bit more room to the upside. I am very cautious on China. However, I do like playing right or right out plays in these types of situations, so this rally could go quite a bit higher. I would say 34s are, let me see, what is this low? The 34s are possible. It could go to just 32s. That's also a 20 MA. You can see that the 100 actually has been kind of grim death for this. So we are quite away from there, and that's also the backside of this trend line. You can see there's also a very high volume node in the volume profile, so it really wouldn't surprise me to see if there was some type of move in China, like some easing or maybe some positive news for a change, that this could have a little bit more room to run, considering we got really close to an all-time reference low. Muscle memory, so to speak. Not helping Chinese stocks all that much. BABA, I said, got into this band. I said I thought it was going to be a consolidation and then it could resolve higher or lower. It resolved lower. It resolved quite a bit lower, and we are now kind of just in a chop range a little bit lower. If there was a rally back up into this area, I think you can try it for right or right out short. It's going to depend a little bit on the tape. BABA isn't really my favorite trading instrument. I've had some varying success in it. I find that it's been sort of not so profitable for me on either end, so I kind of don't trade it all that often. I stick to the ones that I can game a little bit better. But this is still a relatively young chart, but you can see I do think that if we came back up into this area, you have multiple distributions from here, all in here, and there will be a lot of interested sellers somewhere between this 77.77 and likely this 81-ish area. So I would say if you can get a rally up to that high, basically mid-range here, it's probably a sell. IBB. So this was also a very similar pattern. A lot of consolidation. You had what looked like a head and shoulders here. Then it was starting to look... you had a head and shoulders top. You had the breakdown, the check back, a breakdown to basically an equal to higher low, rallying, still making a lower high, starting to look inverse head and shoulders here, although this got a little bit lower than it should. Three tops here against, three tests against the top, and then it completely fell out of bed, made newer lows. So we got back to the breakout, got actually a little bit below there. It wouldn't surprise me to see if there was some type of a check back to the 306 area. So I think somewhere between 306 and like what is this? These lows, 319, 320. I don't know if it could get that high, but that to me would be a good right or right out short. That's sort of where this next volume profile takes place. So it would either be a check back here to really this breakdown below these lows of the 306, or it might want to press a little bit higher mid-range, but I do think this area will set up for some type of at least for a day trade, some type of right or right out short. It could potentially become a swing. We'll have to see. Gilead is holding on to the kind of tail end of the range. You can see it bounced, although albeit gingerly. It's never really gotten the full check back, but this is the lower end of the range in Gilead if you want to play long. I think you could play long against this area. They do have earnings coming up. They should probably be good. So I was actually hoping we would stay weak into there. We may rally ahead of time. If it kind of messes up the trade, it could just be one to avoid and play probably more after the fact. Let's get into SPY. So I already talked about the Fed. I want to show you, this is really where this was the Fed day. And you can see after that, it kind of just fell out of bed. They tried to rally it, and then we broke these kind of double, triple bottoms, whatever you want to call them. And I had said that a close below here, I didn't want to get anyone too freaked out, but the last time we had closed below there, we had free fall. Again, below there, and we had free fall. I also said if we broke these lows, that would also be paramount for free fall, and it really did play out that way, didn't it? We didn't hold these lows. However, we did hold this low with a slight overshoot, and now we're just having some responsive rally back. So I discussed I know my chart's a little bit messy. I know I get a lot of people give me a hard time about it, but I'm not some, paper money trading subscription service. I am a guy who trades my own account with real live money, and, real life isn't always so clean. It is, this is really the chart I use. So we are rallying back up. We have some Fibonacci retracements and some horizontal reference levels that we can use to kind of aid us. I've shown you before that this was the tail end of really the safety zone. Anything below there is rather vulnerable. I drew a Fibonacci retracement from this high to this low, and you can see something very interesting. Look where the 61.8 comes to. It comes right to these reference lows. It also comes potentially, depending on how long it gets there, to channel lows. Moving averages are coming down. If this were to line up with, like, let's say some type of a major extended move, if this just like bulldozed up here, this is an amazing right or right out short. Somewhere between the 97.86 to the 190, basically 200, 199.96. It might overshoot a little bit to the 201.90, but somewhere in this area to me would set up for potentially an amazing right or right out short, if not only for a day trade, potentially for a swing that could last quite a while. We are way bombed out here. Everyone over here was saying we were oversold, and I was saying we were first starting to get oversold. But now you can see we are well below this lower stochastic, both the real and the average, and we are starting to bend back up a bit. So there could be a little bit of a reprieve. I will say this. On this day, this whole day here could be, there's two ways you can look at this. One, this was poor lows. These weren't single prints. I think they were like double prints. Some people consider double prints excess, but you can also, in the context of this day, view the entire day as excess, considering it's a large tail. I would have liked to have seen this day close a little stronger. You can see this body just kind of closed here. The next day was still a lack of conviction, and then you just had some short covering the next day. So this rally doesn't really have, it's kind of looking a little like here. There's a little bit of a lack of conviction, at least initially. The damage is so severe that I think people are just kind of, they're terrified, Nobody wants to take weekend risk. Anyway, the 38.2 is a little bit higher in the 192s. I'm looking more, like I said, at these fibs. I would love to see this have a really healthy rally back up and set us up for an amazing right or right out short. Preferably, coinciding with a confluence, a moving average, a Fibonacci retracement, and prior horizontal support where a major breakdown took place. That, to me, would be quite something. If this doesn't resist, that would mean that this is really a kind of a false breakdown, a false narrative, and that this gap here might fill. I'm not thinking about that right now, though. I'm taking in stages. I think the big problem a lot of traders have is that they don't think in time frames and in levels. They kind of just assume you're going to get the entire move right away, no matter how oversold you were, how many days you're down. It's the same thing as this being chasing to the upside. This here is chasing to the downside. So you had a big, let's say, bottoming tail as opposed to a topping tail, and you have some counter trend move. We are, believe it or not, on the bigger time frame, and I know this is very hard to fathom, we are still in an uptrend from the 2009 low connected to the 2011 debt ceiling crash low. We lost the 2011 bull market rally all the way up, but we are still above the primary trend. We are not in a bear market yet. I know look, we're looking a little toppy. This is looking a little toppy, but we have yet to still break the primary trend. Until you do that, you are not in a full-fledged bear market. I will say that I think there's a lot of potential to be in a full-fledged bear market, and I've pointed out we have reference lows here, and we have never retested the 2000 and 2007 peaks. which I think are very possible. You know, this could, if we lose these lows, these now double bottom lows, then the market to me is a major short, and we're going to probably see primary trend that will probably set up for a pretty decent rally, at least back up to retest here, but it's also possible that we just gun through it and retest that level. There are some other Fibonacci references. I haven't drawn them in here. I will if they really start coming into play, meaning if this trend snaps, but I don't want to confuse people too much just yet. Anyway, so at this point, this is held. If these two lows were violated, then I would say just kind of the top of the market is likely really in at this point, and we would definitely see that primary trend, and at least I think it will support for some type of a rally. I just don't know that that rally won't be yet another shorting opportunity. So that is SPY. Anyway, the expected move is $4.74. That would take you basically to, if it happened that way, you would go up to about 195.26, and if it were to break on the downside, that would be 185.78. So basically back down to these lows. I don't think that move is going to be enough. I think if we rally up, it's going to be more, and I think if we come back down, it has the potential to be a heck of a lot more. Maybe we're just in a little consolidation mode, but that doesn't really seem to be the way the market is trading, so I would be a little bit cautious just based on that. With regard to the ES, or with regard to the SPY, I've been saying for a while, I've been really skeptical. I've been skeptical for a long time, so, I can't say that I didn't see this kind of move coming, but it has been a lot really quick, and I think that it's probably just a little bit of catching your breath time here. Not to say that the market isn't bearish, but it might be a little too much too fast. IWM has been the poster child for weakness. Let's just do 10 years weekly. I want to show you this is we are below trend here. Like you can see, you connect these dots, and that's what has me a little bit more cautious on SPY. You do have a big hammer here off of kind of a reference level, but I was really hoping this would press down here to the 85s. Instead, we stopped at 95s. It might have just been a little bit too much too fast, but IWM has kind of led the way in the past, and it's already showing that trend snap. So this could just be the check back, the kind of the silence before the storm. There's an old reference low at 103.54, and then some up here at 107. So if this were to rally back up into this area, I think you could probably set up some type of right or right out short against, if you want to try against the trend, the 103.54, or if you're a little more conservative, you could even just sell some out of the money calls if you want. Once you get up into here, you could sell some calls up here. I think that this area, between the 107, let's just call it, and the 103s, that area is going to be a good opportunity for a right or right out short, for a right or right out short. Qs have been the kind of the juggernaut. They have been holding. They are above their sort of regression line. I should probably change the color to this. I usually make regression lines blue with ones, and they're just spotted. So we held the just above the big 61.8. I've said anything below the 104, 105 is a little bit vulnerable, but you can see we are well above the low of the box. You can see no body has really in this move been below the box. I'm just trying to line it up here perfectly to show you guys. All right, there we go. You can see even with that day we did have price action below there, but the bulk of it, the body, did not get below. So the Qs are still showing a lot of relative strength on the tape. I'm going to get to that in a moment, but we had poor highs here. This had consolidation. It had a breakdown. Wouldn't surprise me to even see this rally back up. I think this could happen if Apple and Google are good. I'm going to discuss those right after I discuss the Qs. But up into this area, like the 110, I think would be a good right or right out type of a short situation. Let's get to the meat, to Apple. So I was kind of having my druthers here that Apple was coming down ahead of the earnings, getting into flash crash reference lows and setting up for a good long. The only problem is it's rallying a little bit ahead of their numbers, and we do have a trend break, which is good. I'm not going to say that this is bearish, but I would have preferred it to kind of really build the panic and get down a little bit lower into the numbers. But we are rallying a little bit ahead of time, which is taking out some of the shorts, I should say. We did close back up above 100.72, which is, I guess, minorly constructive for the bulls. This was a very positive day on Friday, broke a trend, and back up into a range. You really need to clear the 103.74 to kind of really start to negate the pattern. It is good that we are basically taking out some of these highs. We had some lower lows, but now we're making some higher highs. So I think that the Apple numbers will be okay. I just don't necessarily know how the stock may react to this. If it continues to rally up, it might be a bit of a problem. I prefer the shake and bake, meaning down and then up. But this could have a little bit more legs to it. It might even get to these reference lows, the 107s. Anything, in my view, really below 109 is kind of still a little iffy, but I will say this. If you can get back, like I said, if you get back above the 103.74, it starts to negate the pattern a bit more, and the Apple could start getting a little bit more bullish. However, you do have multiple distributions above you here. This could be like a pop on earnings, last for a couple of days, and then fall apart again. I think a lot of people bought up here, and they're looking to get their money back. So I am a little cautious with regard to Apple. The higher it rallies, the iffy it gets. Look where this 109 is. Look what really begins above there. So I think you could see 109, 110 on the Apple earnings, but unfortunately, I think it might be an area to sell. So that's my view on the Apple. Let's just do FANG. Facebook. Breaking a downtrend here. This actually got a little bit lower than the 200. It got down to the 89s. I had been saying that I thought 86s and 83s would be screaming buy setups. Unfortunately, we didn't quite get down there. Anything in my view here is... So let's get into some important levels here. Above 96 is good. Everything is still vulnerable as long as we're below 99.24. So just keep that 99.424 to 100. But it is constructive to me that we have excess here, and we are now breaking trend with a pretty, with a little bit of conviction. I would, again, prefer this not to rally ahead of the numbers. We used up a lot of the time to correct. You can see how that played out here. I expect their earnings to be pretty good, but I really would like this kind of to, this may rally ahead of the numbers. If it does that, I will probably be a little less bullish for the print. If it continues to kind of just chop sideways, then I think that it might be a setup for a long. It's tough, a lot of these stocks, are going to depend on the tape. We got the move we're really looking for. We are really basically coming down from old all-time highs, so I do think that we could see a move back up to the 50-day. If you're looking for a right or right out short, you could do it against the 50. It's a little disturbing to me that the 50 is bending down now. So a declining 50 up against a regression area, I think could be a good right or right out short, or a good target if you're playing for a move to the upside. Amazon. I can't even voice my level of frustration with this because I was waiting for this 61.8 for a buy, and we missed it by just like a few points, and we had a pretty large rally. Yeah, pretty pissed off about that. I expect Amazon to have a really good quarter. I would have loved to see it kind of have the, set this up, or even press lower to the primary trend. That would be amazing. Maybe if we get some weakness early next week, if we get some type of a move lower. But Unfortunately, this trade is not setting up so well. I do think that the move will likely be up on earnings. I just would not like it to kind of do it ahead of time. If it does, then it kind of messes up the trade. It's all risk reward to me. You know, a lot of people will still take the trade sometimes and make money on it, but for me, it's all risk reward setups. I think you don't even necessarily need to be in front of earnings on a lot of these trades. I think that you'll be able to have continuation or even fades, but more than likely, I'll show you what that looked like in Netflix in a minute. But there have been some fade setups, like Netflix, for example. The pattern here, I had said that these were looking like double tops. I took a lot of heat on that. I said that we would see 115. It did. It rallied. And once we lost that 115 with conviction, we kind of tried to rally again, but it's been making lower highs and lower lows. And we are getting kind of to the lower end of the range, the 93s. And then I think this was the flash crash day, was the 85s. I've said for a while, and I've taken a lot of heat, that 70 is a potential number that we could eventually see on Netflix. I know Barron's was out. They were quite bearish. They were saying it could see 45s. I guess they're looking at the 2007 peak kind of theory also, where this rally really took place from. This is 45, you can see. So I think they're really looking for this to kind of retrace the entire rally. I don't know if I'm quite that bearish, but I do think that it could potentially see the primary trend at some point. Maybe it coincides with that breakout. So I do think that that's potentially possible, but on a bigger picture look, we held the weekly 50 MA. That's why I think you had this bounce. And with regard to the way it reacted on earnings, it was a bit of a pop and a flop. This was well up into this area for earnings, and then it didn't open that way. It opened up junky, and it's been going lower. When stocks can't go higher on earnings, they tend to go lower, so just keep that in mind. I think the 93s are an important area, and I think the 85s would be set up for a good right or right out type of a long for a bounce. It would be a little too much too fast. In my view, this would basically be a fill-up of the triangle down to this low. I have on some put ratios. I might be a little bit ambitious, but I didn't want to have Sunday night gap risk. I did the 85-80s, but if we don't have that move instantly, I might be looking to do something around the 93 area, like sometime early to mid this coming week. Google. So Google is sort of the cheapest of all of these based on a PE multiple. It got one of the channel lows. It's rallying back up. Anything below the 752.05 is a little bit vulnerable. Again, I would have liked to have seen this continue weakness ahead of their numbers, but we're kind of bouncing ahead of them. Hope that doesn't mess up a trade here, but Google is Google. We are at the 20. We're below the 50. The 50 had been support here. So maybe it is a little bit of a right or right out short, at least for a day trade, if we can get a little bit more Momo into there ahead of the print. I wanted to show you one thing here. Look, Google rallied, kind of chopped, and then filled the gap, and then kind of rallied again and chopped, and then rallied. So again, this could be a similar pattern. We filled the gap. It could rally here, meaning here, and then come down again, meaning here, and then chop and rally. On a bigger time frame, we were getting a little close to the channel high. We're now mid-channel, as you can see. You could make the argument that it wants to see channel low. I would love, actually, to play that with put ratios. You can see there's a lot of bands of support between the 615 and the 583. And there's also the channel line there. So if you're a little more bearish on Google, you might want to play from put ratios for a move back down into those reference lows and that support band. If you're more bullish, you'd obviously be looking for a move back up to these highs and maybe to infinity and beyond, as Buzz Lightyear might say. I want to show you some other stuff here before I wrap. I'm going to try to go through it quickly. Chipotle. 4 years, I think a weekly should be enough. We held trend. We have some responsive move back up to retest this breakdown area. and a little bit soft. I want to see this thing pull into a higher low and then take out these highs, and then I think we could see back up into the 532s. But you really want to see it make a bit of a higher low. If you must play it here, I guess you could play it right or right out long versus the the 442s. That to me would be acceptable because it's basically the midpoint of this area. I guess it's a little bit below the midpoint, but I guess on this candle, if you go for the whole wick, you could play against that. I wouldn't be surprised to see this kind of come down and retest and then go. But let's see how that plays out. A lot of that is going to have to do with the market, and their earnings are coming up. I am going to sideline this stock, but until after they report and we hear their commentary. If it's bearish, it's going to really wash out, potentially even down into the 200s. I know that sounds crazy, but it wouldn't surprise me. If it's bullish and their commentary isn't bad, that'll take out a lot of the concern. There's still a lot of shorts in this, and I think there'll be multiple days of continuation higher. So I think this is going to be a second mouse gets the cheese type of a situation. American Express is one that has been rather bearish. This had a head and shoulders top. We are now into some pretty important levels. Let's go back to a 15-year weekly. This was basically a 1.618 Fibonacci extension. I think it was like just under 101 just by eyeballing it. And I think I did the math on this once before. It was like 100 and change. We got just shy of there. We're basically coming back. We lost the 2007 peak, and we are into some deeper fib levels here. We're into a 50% fib. This is basically where this rally took off from. So these 52s, 53s might be kind of a support area. It wouldn't shock me to see this go a little bit more into the 40s or the 30s, just because of this is sort of just the start of I don't know if this is sort of the start or the end of the breakdown, but this area is important. If we lose there, then I do think we would see the 61.8. I am looking for a longer-term long setup on this. This is now trading like basically at 9 or 10 times earnings. A lot of the bad news is out there. I mean, we know about Costco. We know about, that they're kind of slowing their earnings prospects down. This is still a premier brand. They have, a decent dividend. Warren Buffett's involved in this stock. So I am kind of looking to get involved somewhere between these 53s and these 41s or 42s. I think in this pocket in here is going to find some support. I'll likely be selling some out of the money puts there. You can see this is getting rather steep, and another, little bit more move down. Usually these don't end with these moves. There's usually a little bit more continuation, but I think that will set up, believe it or not, for some type of a pretty sizable bounce. ALKS. This is one I've been keeping my eye on for a while. Wow, this is quite a pummeling. This is like 3 big weeks down. We kind of held the 61.8. It did look below it a little bit. I think that this could have a little bit. I really would love to buy it against one of these trend lines. It might be a little bit too ambitious to think that we could get there, but this has moved a lot. You could see, look where the trend comes in along with this peak. And this low. I would be really interested in this in like the 25 area. What's the low here? Yeah, the 26 to 25. I would be real interested in there if it does come into this reference low and these past areas. I think it would be considerably oversold, and it would have taken back a lot of the bearish opportunity. I think the reason for this was they had an issue with one of their drugs. I think it was one of their depression drugs. Wow, their shareholders are sure depressed now. You took out this low. I am expecting some type of a responsive rally in this, but I kind of like to give, once you've seen some free fall in these stocks, I like to give it a couple of days. You can see this, we got a little bit of a bounce here. It might see still some more. If you want to play right or right out long for a day trade, I think you can play it over this high. but it's a GTFO. If you start losing this, I don't think I'd even give it to this tail. I think I would use the bodies. You can see that this low coincides with this body. So if you started losing, the 33s again, I would be, so basically the trade would be long over 36.22, and then you'd be risking about $3. You'd be out below 33.66. Kind of simple with that. Nike is a big one. They kind of topped on their earnings. It's now making lower lows. However, this is from an all-time high, so it doesn't surprise me that we're rallying back up. Could see the 50-day moving average. That to me would be, if you're playing long, this would be your target. And if you're looking for a short, you could play right or right out. Preferably, it would coincide with these lows. Disney, another one, not looking all too pretty. This is sort of enough to have filled the gap. Double top looking. We are basically down to these reference lows. That's why you're seeing the bounce. I think that the opportunity here will come in soon. Oops. Don't you hate? The snap feature is supposed to work here. 120.65. Let me just do that quickly, and we'll wrap on this. 65, and the low was 90.42. So you could see the 61.8 would coincide here. There was some congestion. That would be a great short. I don't necessarily know if we're going to get that high, but I do think that a retest of the backside of this trend line and this volume node and this 38.2% fib would be a good right or right out short. So if you can get back up into like that between 100 and 102, probably is going to set up for a good right or right out short. Anyhow, we'll wrap on that. I hope you guys found this video helpful. If you liked it, please hit the thumbs up. Be sure to subscribe to the channel. You'll get notifications when I post new videos, these weekend review videos. I also do periscopes. They're rebroadcasts and special edition videos. Get to see these, get onto this channel. Anyhow, let's have a good week, and cheers.